for joining us today for this Drewry webinar on the outlook for the container shipping market. I'm Simon Heaney, Senior Manager of Container Research at Drewry and the editor of our Container Forecaster report. My co-pilot today is Philip Damas, who's the Managing Director of Drewry and head of our Supply Chain Advisors team. Yeah, the presentation will take about 20 minutes with 10 minutes for Q&A at the end. Please submit your questions during the presentation using the panel on our screen. There will be an email briefing that will be sent out to registrants shortly after the presentation, and that will include a video link to the recording, Q&A summary, and a PDF copy of the slides. So before we start properly, I'm very excited to announce that we are making a major enhancement to our Container Forecaster subscription service, and that's what provides most of the data and the insight that's used in today's presentation. And we are adding container shipping now to our Drewry On Demand, which is our Maritime Research Knowledge Center. So access to this new online service will be complimentary as a free enhancement to subscribers' Forecaster subscription package. So it's going to allow users to access and visualize the data as it becomes available, as well as building your own data visualizations and comparisons of key variables, among many other features. So more information will be winging its way very soon over to our existing subscribers. So any current subscribers that are tuning in today, or indeed anyone else interested in becoming a new subscriber, please feel free to contact us to arrange a demo of our on-demand capabilities. Right, let's get this show started properly. Excuse me. So container shipping showed remarkable resilience in the face of significant challenges in 2025. Amid the ongoing Red Sea crisis, there was unprecedented tariffs and various other supply chain disruptions. Amongst all that, global container throughput growth reached 5.5% for the year, which is well above our early year forecasts. While US trade and economic policies have contributed to a slowdown in North America, these policies have inadvertently spurred container growth in other regions. So trade patterns are shifting as China redirects its exports to other regions to compensate for the loss of US flows. At the same time, emerging markets such as Latin America, South Asia, Southeast Asia, and Africa have experienced a large resurgence. And this underlying robustness was further buoyed by the easing of some of the more extreme tariffs through trade deals and resets, and the resolution of regulatory uncertainties, most notably the recent suspension of China and US port fees, has also boosted trade optimism. Nonetheless, the overall risk outlook remains tilted to the downside amid significant geopolitical and macroeconomic flux. And on our part, Drewry is of the opinion that container growth last year was somewhat artificially inflated by front loading and inventory building strategies, to the extent that there will be a hangover in 2026 with global growth moderating to about just under 2%, 1.8% is our latest forecast. So therefore, we anticipate thereafter, as you can see, our forecasts are on a 5-year forward cycle. In December, they ran through to 29, and we anticipate that after this year, growth is going to be more in the sort of traditional 2 to 3% range through the end of that forecast horizon. But I should add that demand growth will be slower than we predicted if indeed a trade war intensifies between Europe and the US. So moving on to supply, last year was another record year for contracting. So that's 3 times now that's happened in the past 5 years. All told, orders amounted to 4.8 million TEU, which is just slightly up on where we were in 24, about 100,000 TEU, and about 250,000 TEU up on 2021. The surge in activity has pushed the order book up to unprecedented highs. It's now over 11 million TEU, or approximately 1/3 of the active cellular fleet. Deliveries of container ships were approximately, on average, each month about 180,000 TEU, while demolitions in their entirety only amounted to 6,000 TEU over the entire year. So it's therefore no surprise that fleet growth continues to run well ahead of demand. We are estimating that the active fleet ended last year up 7% year on year. Now that's slower than the exceptional growth of 2024 when the fleet surged 11%, but it is still problematic given the compounding effect of sustained oversupply. Now, there was a brief pause in contracting in 2023 when there was just sort of 1.5 million TEU ordered. So that's going to translate into fewer deliveries in 2026. And combined with what we're assuming is a pickup in scrapping, this should temporarily slow fleet growth to around 3% this year. But that respite, in our view, is going to be short-lived. The wave of contracts that were placed last in 24 and 25 is going to push the annual fleet growth back up into the 6 to 9% range from 27 onwards through to 2029. So, absent a very dramatic and unexpected acceleration in demand, some form of capacity discipline is going to be necessary. And there are tentative signs that preparations are underway. Last year, feeder and intermediate vessels, which is where the older ships are concentrated, accounted for the majority of new orders in numerical terms. The number of feeders, which we define as up to 3,000 TEU, were roughly 1/3 of all contracts last year. That's up from a quarter in 24. And if we include vessels of up to 8,000 TEU, the share of smaller and mid-sized ships rises to approximately 2/3 of all contracts last year, and that's versus 38% in 24. So there has been a renewed interest in the smaller ship segments, and that suggests that owners are aware of the need to renew these aging segments. And I think it also reflects expectations for stronger intra-regional trade flows among persistent geopolitical tensions. But ironically, it's those same dynamics that may encourage owners to hold on to vintage feeders for even longer. I think old-fashioned competitive dynamics can provide some of the explanation for why we have such an excess within the industry. There are hundreds of carriers, but only a handful really have the scale to move the market. When one large player acts, the rest are eventually sort of compelled to follow. And I think the roots of the current capacity surge can be traced back to the start of this decade, when MSC set out to overtake Maersk as the world's largest carrier. They achieved that objective in the first quarter of 2022, but MSC has since widened the gap very aggressively through an unprecedented combination of new build orders and second-hand acquisitions. And over that time frame, MSC has increased its market share from 17% to 21%, and that's even while the other top 10 carriers collectively have actually ceded share to smaller players, albeit very marginally. So the global fleet, cellular fleet, has grown by around 8 million TEU, or 33% over the past 4 years, and MSC alone accounted for 2.7 million TEU of that, or 34% of that growth. If we look at the next largest contributor, CMA CGM, they added about 11% in incremental capacity, but they actually still lost market share over that period. Now, MSC's strategic objective to operate independent as a truly global carrier outside of an alliance, that has been achieved. They are now larger than the Gemini cooperation partners Maersk and Hapag combined. They also have an order book that's exceeding 2 million TEU, so it's very well positioned to extend its lead further. And against this backdrop, I think we have to look at new orders placed by top 10 carriers more as defensive positioning than anything else. MSC's ascent has triggered a quasi arms race one that few carriers appear willing to opt out of, and that's even at the cost of prolonging the industry's capacity imbalance. Now, as I mentioned briefly, our supply projections rely on a material acceleration in demolitions. Our forecast assumes that scrapping will hit around 450,000 TU this year, and that will rise to approximately 700,000 TU per annum in each of the following years. Now, given the industry's reluctance to scrap in recent years, this well may prove to be too optimistic. If we look at our forecast for this year alone is nearly equal to the total capacity that's been removed from the fleet over the past 6 years combined. Now, the logic behind our higher expectations for demolitions is fairly straightforward. There is a growing cohort of ships that are firmly within a traditional retirement window. As of the end of last year, 4% of the fleet, or 1.3 million TU, was at least 25 years old. So the need to restore market balance, and particularly as Red Sea diversions unwind, only reinforces the case for capacity reduction. Now, strong charter earnings and weak steel prices don't offer huge incentives to owners to scrap, but the argument for disposal is becoming increasingly difficult to ignore. If you keep hold of these vintage container ships, it merely defers the problem, stockpiles over capacity in the market that will ultimately weigh on future freight rates and margins. Now, the resumption of full-scale Suez Canal transits is a major sort of driver of what will happen to freight rates this year, and that does appear to be coming closer to reality that at any time since the Houthi rebels started attacking ships back in late 2023. The Gaza ceasefire is just about holding, and the messaging from the Houthis is that it's a suspended attacks, although of course there are conditions that it could restart if the situation in Gaza deteriorates. Major carriers are now testing the water with a number of additional Suez transits in recent weeks, and definitely at the forefront of our thinking is that the speed with which carriers return to Suez is going to have a major bearing on freight rates in the coming months. If we were to see a sudden return, that would likely see pricing fall very sharply. But on the other hand, a more orderly and gradual approach that doesn't overburden ports, in our view, is going to result in a far shallower and less volatile price decrease. But I should add that overcapacity that exists in the market is going to see prices come down regardless of how quickly Suez transits resume. So ultimately, it will come down to carriers' own assessment of the risk. We know that insurance premiums, as expressed as a percentage of the vessel hull value, they are lower than they were at the peak. They're currently, I think, about 0.2, 0.3%, and that's down from as much as 1% at the peak. So insurance cost is now less of an impediment, but shippers, cargo owners, might push back against their valuable cargoes being put at risk. And we know that depending on the direction of the voyage and the size of the ship, the multiple of the goods value versus the ship value can range from 5 to 10 multiple times. So in our opinion, carriers are likely to take a cautious approach, although there will be different strategies between carriers and different alliances. So in our view, a hybrid routing is going to be the prevailing mode for this year, whereby carriers are going to start with more backhaul and lower cargo value Suez transits, but keep on using the Cape of Good Hope for the higher value head haul voyages. So this is going to mean that more effective capacity will be sort of drip fed back into the market over the course of the year. So it won't happen all at once. It will give carriers more time to assess the risk reward position, prepare their future networks, and prevent a total collapse in pricing. So from this edition, that is now Drewry's base case position regarding Suez. Clearly, there is a lot that can go wrong that would require us to backtrack from that. There's not been a huge amount of progress in terms of the US brokered peace plan for Gaza. So any sort of change in that scenario can alter the dynamics very, very quickly. And to keep on top of that, you might be interested that Drewry has now introduced a new tracker index of Cape and Suez voyages that we've launched free of charge on our website. You just need to register and you can keep a track of that. Now, we've been actually tracking container ship transits of the Bab al-Mandab Strait using AIS technology for the forecaster for longer. And you can see from this slide that transits, which we represent here by nominal capacity, have indeed picked up slightly in the last few months, very, very slightly, but there's still only about 10% of what was sailing through the strait before the attacks. And our AIS data also allows us to interrogate sort of annual transits by carrier. This slide shows you that nearly all of the top 10 carriers stopped using the route, with only a very handful of voyages in 24 and 25, the notable exception being CMA CGM, which benefited from French Navy escorts. But even then, CMA's CGM's transits were well down by about 85% on their 2023 numbers. So I think also notable on the right-hand side of the slide is that carriers outside of the top 10 actually increased their transits steadily since 2023. And I think this is further evidence that there is quite a wide difference in the risk tolerance between larger global players versus the smaller regional operators. So before I go into our forecast for supply demand, freight rates and profits, I think it's important to sort of shine a light on the major sensitivities that could derail our forecasts. We are cursed to live in interesting times, and making predictions on the container market has never been more difficult. I've already touched on the Suez Canal, but there are other external risks. The tense geopolitical situation is the big one. And a feature of last year was how US tariffs upset traditional shipping patterns, where you had huge front-loaded demand surges ahead of deadlines and then crashing lulls thereafter. Now, while some of the biggest excesses of those Liberation Day tariffs have been moderated, there is a chance of similar happening again in 2026. The US Supreme Court is due to give a ruling on Trump's use of the emergency powers for tariffs any day. The lower courts have already ruled against the president. But even if they do find against Trump, it doesn't necessarily spell the end of tariffs. So the emergency powers were the chosen weapon because they were immediate, but there will be other resources open to President Trump should he choose to rebuild his tariff wall. The most immediate one would be Section 122. He could impose duties of up to 15% across the board for a max of 150 days. That's a stopgap measure, but that would enable him to then potentially use other tools such as Section 232 or 301, where they could go for higher targeted tariffs after an investigation by the USTR, for example, although those would likely be more expedited than we've seen before. But the upshot is that means there could well be a brief window this year in which where we see worldwide duties suddenly become much lower than they are, which would lead to an almighty rush to get goods into the US before they go up again. And now such an outcome would see freight rates surge for US inbound container trades, as carriers simply won't be able to add enough capacity at short notice. So that's a major risk for freight rates. Then, of course, we have the almost surreal possibility of NATO members facing up against one another due to the US's determination to annex Greenland. Now, this is something we flagged as a risk back in June of last year in our container forecaster report. But since then, we've had the US excursions into Venezuela and President Trump's repeated statements on the subjects Suddenly, it now doesn't seem so far-fetched, and in such an outcome, it's very difficult to see how carriers with headquarters in other NATOs, and in particular Denmark's Maersk Line, how they could continue to serve the US if it goes ahead with military action over Greenland. The situation in Iran is also extremely unpredictable. The Houthis rely on the Iranian regime for their funding, so any change there could make shipping safer in the long run, but have some very immediate short-term risks. Then lastly, carrier behavior remains the major unknown internal risk. Will carriers start to attack the industry's overcapacity problem, as we think they will, or will they kick the problem down the road again? Now, this chart shows you our global supply demand index. 100 represents perfect balance. Readings higher equal undercapacity, lower overcapacity. So for this year, we think it's going to slip from about 86.5 points last year to about 81 in 2026. But if we factor in more idling of ships, that'll push the index up closer to where it was last year, around 84 points. Better, but still way off market equilibrium. But as you can see, we anticipate that the imbalance will only worsen for carriers through to 2029, and this already takes into account our expectation for more scrapping and ongoing port congestion, which saps capacity from the market. So obviously any escalation in line of disruption from external events, could potentially see that line move closer to 100. But in our view, that does not constitute a plan for carriers. And in any case, we don't think it will be enough to overturn the market back into carriers' favor. Last couple of slides from me. So for 2025 average rates, which are spot and contract rates combined, they were upgraded marginally in our last report, although we have downgraded our forecast for 2026. A gradual return to the Suez Canal will still have negative implications for East-West trades in particular. So we expect average East-West rates to decline by about 24% this year, while global rates are expected to come down about 16.5% by that much. So a less dramatic decline than seen in the East-West trades, but still a very large reduction, and the second in a row, which is going to have big revenue and cost implications for carriers, forwarders, and shippers. Now we're looking at carriers' profit forecasts. So their EBIT margins fell to about 12% in the third quarter of last year, which is the last results we have. And that's well down on the sort of 35% recorded in the third quarter of 24, which was the peak of the Red Sea crisis. Nevertheless, margins improved actually sequentially from the second quarter when they were about 8%, and that was supported by slightly higher quarter-on-quarter freight rates. So that was a slightly unexpected change of direction in our view. We had anticipated that margins would shrink further in the third quarter, and because of that, we have upgraded the annual forecast for 25 to an EBIT return of 32 billion, and we've also raised the outlook for next year from negative 10 billion to plus 1 billion for this year. So still only just close to sort of break even. Now, before I hand over control to Philip, I just wanted to say that Drewry's Maritime Financial Research team are going to be about to release their annual carrier financial health check at the end of this month. So that's going to give readers a much deeper dive into how lines are positioned. Right, so that's all from me. I'm now going to hand over to Philip to give a shipper's perspective on things.
Thank you, Simon, and thanks for highlighting all the challenges of carriers and the implications for other stakeholders. So here, I would like to share with you some of the discussion points that we at Drewry have with our many shipper customers, because the market is becoming a buyer's market, a shipper's market. And I'd like to share with you how shippers now focus on different things this year when compared with last year. So first, more shippers now agree that choosing a carrier or choosing carrier service is not just about rates. So since the pandemic, the focus of logistics, I would say, has evolved from a 90% focus on the lowest cost to perhaps a 70% on the lowest cost and 30% focus on resilience. So this is the first block on this chart. Now we're finding that container shipping, one of the key requirements is having a minimum level of resilience, having a minimum level of reliability, and helping the shippers and other stakeholders avoid or mitigate all these disruptions, port congestion, and other issues that Simon highlighted. So that's an important change from a shipper's viewpoint. Second part is technology. So we are at Drewry focusing on some technology changes. And now we see that the shippers are expecting more data integration, more automation, including a number of tools, some of which, like rate benchmarking tools, are provided by Drewry. And the carriers and others are expected to provide use cases for AI to support the productivity or help the shippers negotiate better contracts or plan better. The third point here is rates. So Simon said that overcapacity is getting more acute. So it's frankly a given that there will be low freight rates in 2026 and in 25. The shippers expect that. And on top of that, if and when the Suez Canal transit resume in full, we advise shippers that they should have a review clause. They should review their rates with their ocean carriers or forwarders to reflect the new reality of global routing via Suez. So from a carrier viewpoint, particularly the carriers or the shippers who are negotiating trans-Pacific contracts in sort of February, April, the overall environment is that there will be low freight rates and expectation of more reliable or more resilient services, which will be demanding for carriers. Moving to the second point on reliability. So Drewry tracks schedule reliability on most east-west trade routes. And one of the key developments which attracted attention in the past 10 months or so was the improved schedule reliability of the Gemini carriers. As the chart shows, you can see at the top Hapag-Lloyd and Maersk. These two carriers are leading on schedule reliability recently, and shippers are paying attention to this, and this plays to the requirement I mentioned earlier that now it's not just about trade, they also expect higher reliability. So the ability to provide improved reliability and slightly higher or average freight rates is a good combination in the current market. So to conclude, that was a brief view on the shippers market. So looking at all the different facets of container shipping, the takeaways are the demand outlook is relatively weak, weaker than in previous years, with additional risk like the US-Europe trade war potentially, other geopolitical concerns. So that will mean slow demand growth in 2026. On the other side, on the supply side, yes, fleet growth will also be relatively muted, still higher than demand, but muted for 26. But the question mark is that there is a lot of new capacity coming in 27, 28. So that will shape the medium-term prospects for the container shipping sector. And it's not just about the number of ships, it's also how quickly the ships turn and operate. And the expected return of Suez transits will have an impact on what we call effective capacity, making overcapacity worse. I explained that the shippers are shifting their expectations. They want service reliability. Considering this as part of the bid process, and we support shippers who look at this, and they're expecting lower freight rates. So supply chain resilience is a key concern. Therefore, three flags or three alarm bells to watch with your job. Watch with volatility and disruption because they are driving the market. Fortunately, the carriers have better balance sheets, are better placed than before the previous downturns to cope with the current challenges, but they are likely to curb future investment. And the third point is how low will the freight rates go? And history suggests that carriers will go to the brink, in other words, lose money before they address overcapacity. And at Drewry, we'll be watching all these trends in the container forecast. Back to you, Simon.
Excellent. Thank you very much, Philip. Okay, so we have gone slightly over our schedule, but let's see what questions have come in. Okay. Let's see. Okay. Okay, a couple of people are asking whether we will share copies of the presentation. Yeah, absolutely. That will come after, hopefully tomorrow, or maybe even today, depending how quickly we can turn it around. But copies of the presentation along with a video link, etc., will be sent, and a summary of the Q&A. Now let's see. Maybe this is one for you, Philip. Let's see if we can get this out. Someone's asking, anticipating a Suez return in 26, is it a good idea to negotiate rates for both Cape of Good Hope and Suez in this year's tenders?
Yes, we find that many shippers are asking for effectively two rates, one for current transit via Cape and one for Suez. So that's an option which makes it easier later on to effectively apply the relevant rates at the time. Another option, as I mentioned, is to negotiate based on the Cape routing and have a specific review clause saying when the Suez Canal transits resume fully, then there would be a renegotiation. But doing it up front is probably easier and clearer.
Brilliant. Thank you, Philip. Another question, I'll take this one. What's the view on the supply situation of smaller vessels, the ownership tonnage provider versus liners? Okay, yeah, I mean, I think to a sort of an outsider looking in at the market, you have so-called, you have analysts such as Drewry saying that there is overcapacity in the market, but then you see that the charter market is actually very robust. And I think that's because we have a two-tier scenario here. Globally, there are too many ships, but there are pinch point at particular sectors, and the issue really is at the smaller feeder ships, which is where the charter market really sort of operates. So that's sort of up to 8,000 TEU. I think the issue has been it's a question of availability. We've had during COVID, we had shipping lines chartering ships for very long duration so they could secure that tonnage. So that took them out of active service. We've also had the Ukraine-Russia war, whereby a lot of the trade from China to Russia has been sort of restructured to use feeder ships. So they're effectively out of the picture. There is also the situation whereby a lot of carriers, in particular MSC, have been aggressively buying second-hand ships. So that balance between owned versus independent owners versus operator-owned ratio in the fleet has significantly gone up for carriers. So it's now, where it used to be 50-50, it's now more like 60-40 in carriers' favor. So that just again reduces the pool of available ships in that smaller segment. So that really is the issue, and which is why the charter market has held up for longer. And now, of course, we are seeing, as I said earlier, more interest in ordering of smaller ships. So that should sort of start to ease some of the pain in terms of access to smaller ships. So hopefully that answers your question there. Let's see what, maybe we've got time for one more question, Philip. Let's see if I can find one. Maybe one for you, Philip, here. How much volume moves under contract and how much is spot?
So if you say that a spot is effectively the forward volume plus the remaining volume negotiated directly between carriers and shippers spot market, it's approximately 40% spot and 60% contract. It depends on the trade routes, but approximately that.
Okay, great. Okay, I'll try one last quick one from me then. So someone's asking sort of technical question about our supply and demand index. How are you taking into account the tonnage miles and the vessel speed difference with, between the current scenario with Red Sea diversions and once transits return? Well, our proprietary index, which has been up and running since the beginning of this century, it does take into account already trade distances, takes into account vessel speed, and various other factors that all affect what we call effective capacity. You can't just look at the fleet, the cellular fleet, and its growth. You have to look at how efficient that fleet is operating and how much capacity is available in the real world. So we do already do that. And for the Red Sea diversions, our calculation was that because roughly 30% of the fleet was using the Suez trade, and we've added a 30% increase in distance or time. Therefore, we estimate it's approximately 9% of capacity that has been reduced or stripped out of the market simply due to Red Sea diversions alone. As I say, we anticipate that that deduction will slowly increase as more ships go back through, but there will still be other mitigating factors such as slow steaming, which is still prevalent. Ships are nowhere near operating near their design speed, and also port congestion, which has remained very stubborn despite obviously the end of COVID. So we don't anticipate we will get back to pre-COVID levels of port efficiency at the end of our 5-year forecast. Okay, I think that we will have to wrap it up there. I think all that really remains, well, as I mentioned earlier, there will be an ability for us to answer some of these unanswered questions within our follow-up emailer, which you should get in a day or two. But other than that, all that remains to say is we hope you found today's webinar useful, and we look forward to seeing you at future Drewry events. Goodbye and have a good day.
Goodbye.